Chapter 11, the course is still Introduction Managerial Accounting. So let's remind ourselves what we studied so far. We study to prepare you to be a manager. And that's the whole objective here. And as a managers, you have to do some activities which are planning, directing, motivating, controlling, and decision making. In the meantime, once you create a company, you're gonna choose the strategy of the company. That strategy is going to differentiate you from everybody else on the market in order to attract the customers, which customer is going to bring you the revenue that you want. So that's on the revenue side. On the cost side, for the cost purposes, we found that based on different classification, we can have a different purposes, we're going to have different cost classifications. Based on where the costs are reported, on which statement, we have product cost and period cost. Based on how the costs behave, they behave as a variable and fixed cost. Based on how the costs are traced to the product, we saw that we have a direct and indirect cost. For decision making, next time we're going to see that we have a differential cost and some other type of costs. And then we went to the cost volume profit analysis using the fact that costs behave as a variable and fixed cost. Then we prepared the job costing, and we saw that in order to produce a product, we need direct material, direct labor, manufacturing overhead. Then we went to the manufacturing overhead, and we saw different methods to allocating manufacturing overhead: traditional, non-traditional, activity-based costing. Then we prepared the budget, which is part of the planning process. Then we did some control over the budget and comparing the actual results with the standards, which standards are used to prepare the budget. And here we are today. Now we're going to start reporting for control. In order to keep control, we have to do some reporting. Now, before we start, let's think about it. Imagine each of you told me that when somebody opens a company, their objective is to generate profit or to generate cash, which is true. People usually open company because not because they want to spend money, because they want to generate money. And one of the way to generate money is to open your own business or start your own initiative or idea and convert it into business. So once you start your business, if you by yourself, eventually, if the business is successful, that business is going to grow. Once the business grow, you have options how you're going to structure your business and what kind of structure of the business you're going to use. One of the available structures for the business is a business organization is decentralized structure. One is decentralized when you are under control and you're telling everybody what to do. So if that's what you're going to do in the beginning of the business, that makes sense. But eventually, as long as you develop your business, you want to have some more time for some strategic decision making, for some thinking about the strategy of the company, thinking about how to attract new customers, and you want to let the people go, not to go with the business and start replacing you on the decision making. One way to do this is to decentralize your organization in terms of you start delegating more responsibility to the low-level managers. What will be the benefit if you do that? Now, the lower-level management, we're going to start gaining experience in decision making. Gaining experience is a good thing, but can go against you as well. Once you delegate the work for those managers, low-level management, or other workers in the company, what's going to happen? You're going to have a free time so you can concentrate on the company strategy or how to attract more customers. Usually, when you give the authority to the people to make decisions, that's going to increase their job satisfaction, so they'll be happy at their work. At the same time, since they're close to the customers, they will be able to respond quickly to the customer needs, and they're going to have decisions that they're going to make will be based on the better information. At some point, you might lose the track of day-to-day operation of the company, not because you want to, but because you're busy with other things that you're doing in the company. Now, those are the benefits, but everything that has a benefit has drawbacks as well. What will be the drawbacks if you decide to decentralize your system? Now, the lower level of management, they're not going to see what you see because their motivation is not your motivation. Their objectives is not your objectives. Your objective is you to generate wealth for yourself and for your family. Their objectives are different. So somehow you have to align their objective to your objective, which will be interesting thing to do. Why? Because again, they won't be able to see the big picture, and they might not see the big picture, or they might don't want to see the big picture. They just want to come here at 8 o'clock in the office, leave at 4:30 or 5, and that's it. Go and live with their life. You, on the other hand, you have different objectives. Too much decentralization, it can lead to lack of the coordination among the autonomous managers, or you may even have a duplication of work without even knowing that that's happening. And the last thing is that when you do the decentralized system, it might be difficult to spread innovative ideas in an organization. Why is that? Because again, your objectives are not objectives of the managers and the workers of your company. They gonna be there only to get the salary that you attract them on the job interview when you first interview them. After that, after 5 o'clock, what's going to happen with the company? That's not their business. They don't want to know, and they're not going to ask you, what are you doing after 5 o'clock? So you'll be the one who have to deal with everything, see the big picture, choosing the objectives for the organizations, for your organization, coordinate the activity in between the managers, and spreading the innovative ideas. But since it's decentralized now, it might be difficult to do that. And now we can see the different stages of the business. So in the beginning, when you open the business, when you're by yourself or when you're with a small amount of people, it's easy to control. So most likely on that stage of the business, your company will be centralized, going to have centralized structure. As soon as the company start growing, you're going to start delegating the work to the other managers. So you're going to introduce that decentralized organizational structure. More decentralized organizational structure become, more problems you're going to have. Why? Because of the people not seeing the big picture, people working for their personal interests rather than interests of the organization, and difficult to spread new ideas. In fact, you may see the people start doing whatever they're doing in their own personal interest by implementing activity which are not approved even by you. So now you can see from the centralized, we're going to decentralized structure. And more do you know what's the next stage when we're going with the true decentralized structure? Next stage is chaos. Means everybody doing whatever they want to do. There's no coordination with the activity. They start looking for their own authority. Next stage, if we're looking for if you put this structure in the societies and we look back in the history of the humans, and we look in the history of the companies as well. Now, the good companies, they have centralized structure in the beginning. Then they spreading the decentralized structure to some extent. They not leave it too decentralized, but in the human civilization, that will be difficult to happen. So when the the whole structure become too decentralized, then become a revolution, then become a chaos. Next stage after chaos is a revolution. Why? Because somebody will try to take a control again and make it centralized. And once that happens, running for some period of time as a centralized, then become a decentralized, and that cycle keep going and keep going, keep going. Now, knowing that when you're the manager of the company, you have to be careful when you start decentralizing the company structure or your company, if you start your own company, not to go to the stage of the chaos. So you have to leave some level of control over certain managers. Usually that will be the key managers, which are going to report directly to you. And that's going to help you to be successful in your company. Now, in order we to get idea what's happening in this decentralized company, which having different now manager for different activities, if I'm looking on the overall report of the company, there will be nothing to see there. I cannot see how this department perform or how that department perform, or which center perform well, which center doesn't perform well. So for that reason, I'll need some segment reporting from my organization, which will be extract information about the revenue, costs, and profit for certain division of the company or certain territories or certain sales centers. That will be called segment reporting. With segment reporting is going to give you ability you to have control over different segments of your company. Either going to be division, it is going to be centers, it is going to be territories, it is going to be individual store. That's a different story, but again, those reports going to give you idea how those different units in your company perform. There are two keys to build segment reporting. First, you better use contribution margin format. Why? Because separation of the cost on the fixed and variable can easily enable you to calculate the contribution margin per division or contribution margin per territory or contribution margin per store. The other thing is you have to be careful though, because traceable fixed cost should be separated from the common fixed cost. So now we're going to have on the fixed cost, we're going to split it by two, traceable and common. Now the traceable will be the one that exists only and only because we have particular segment or particular division or particular store. Once that store disappear, those fixed costs will disappear as well. Common cost will be the cost that exists with or without that segment or that division or that store. So the common cost will be common for the business or to the organization in overall, not to particular store. So even if we eliminate that particular store, that cost still gonna stay there. Now, for example, let's see, let's give you some example for the traceable cost and common cost. Now at home, besides my wife, we have two kids. There are two kids. Now, as you know, right now is the vacation period for all those high high school students or kids. So they're at home. What they're doing when they're at home, there's only one activity that they're doing. I mean, there are two, three activity. Either they eat, either they sleep, either they're watching Netflix. One of those three. So now let's go focus on the Netflix. What's interesting with the Netflix? Netflix comes with a cost. Somebody has to pay the cost. So now the question is, for my household, what kind of cost is the cost for the Netflix? Is it common cost for the family or is it traceable cost to the kids, since the kids are the one who are watching Netflix? Now, how we should think? I'm paying monthly fee for the Netflix. Now the question is, if I get rid of the kids, can I save on the Netflix cost? What do you think? No. So what's the conclusion? Better don't get rid of the kids. Why? Because I still have to pay for the Netflix, since it's the monthly cost. So what kind of cost will be Netflix for me? Traceable or common cost to the family or to the kids? Common cost. Does that make sense? Traceable cost will be something that the kids we signing them for soccer or for other activity like a swimming. So every those activity those are related with cost. Now, if the kids were not existing, that cost will disappear. So now the cost for the soccer practice or cost for the swimming practice, those will be traceable cost to the kids. I know I'm using my family for example, but at least that way you can kind of feel it, which one is traceable cost, which one is common cost for the organization. So now, how are we going to allocate the cost? We can allocate the cost to the divisions based on different approaches. One approach is based on the activity. Means that we're going to identify some activity which is common for all the costs. We're going to get the total cost and we're going to assign some of that total cost to each activity or each division based on the activity which that division using. For example, this company has three products, 9 inches, 12 inches, 18 inches pipes, which are put in the one place warehouse, which place is 10,000 square feet, and we're paying for dollars per square feet. Now, the question is, how much of the warehouse cost or rent cost I should allocate to each type of pipes? Now, if we look in the occupancy of those pipes, now 9 inches pipe occupy only 1,000 of the square meters, 12 inches occupy only 4,000 of the square meters, and 18 inches occupy 5,000 of the square meters. So if my 10,000 square meters is 100%, then I can proportionally allocate the cost, or I can use the square meters to allocate the cost. So 1,000 is gonna 1,000 times $4 per square feet is gonna go to 9 inches, and respectively for the other two type of pipes based on the occupancy that they uh, take into my warehouse. Now, it's important to realize that the traceable fixed cost in one segment may become a common fixed cost to another segment. So that's why it's very important you to identify at which point of view you're looking at the cost and how the cost, which is the object that you're tracing the cost to, in order to identify are they traceable or are they common cost? For example, landing fee, which you're paying on the to land the airplane at the airport, is traceable to the particular flight, but it's common cost for the airplane. So we cannot trace it to the different type of classes that we may have or passengers that we can sit on that airplane. For example, imagine we are Arab Emirates and we have our airplanes. We're flying our airplanes. On every airport that we're landing, we have to pay those landing fee. Otherwise, we cannot land our airplane to that. Unfortunately for us, because we're living here, YVR or Vancouver Airport has one of the highest landing fee in the world. So that's why there are not so many airlines that want to travel to Vancouver. There are so many, probably 5 times more airlines that travel to Seattle, but not in Vancouver. But that's a different story. Now, in order the airplane again to land, you have to pay the landing fee. If I have different type of classes, let's say business class is one, first class is the second, and economy class passenger, now I cannot trace that cost to the passenger because if I eliminate the first class, I still have to land the airplane. If I eliminate the business class, I still have to land the airplane. So how many classes or passengers I'm going to have in my airplane is irrelevant. So the cost of the landing should not be traced to the profit per person that we're generating from different type of classes or contribution margin in this case. Segment margin, which will be equivalent for the contribution margin, but including the traceable fixed cost. So it's a segment margin which is computed by subtracting the traceable fixed cost of the segment from the contribution margin is the best guide to the long-term profitability segment. So we're going to see the segment margin, then we're going to add the traceable fixed cost, and then we're going to see the division margin. So let's take example this company which have two divisions. One division produce computers, the other division produce television. Let's take a look at the television division. Television division itself, the sales are income statement of the television, including sales, $300,000, variable cost of goods sold, 120, other variable cost, 30,000, total variables, 150. Contribution margin only for this division is 150. Once we added the traceable fixed costs, which are traceable only to this television division, we can see that this division contributes $60,000 to the company net income. Now, when we're combining those television division with the company, what we're going to see? We're going to see that company itself making $500,000, but $300,000 comes from television and $200,000 come from computers. Variable cost $230 for the entire company, $150 from the television, $80,000 from the computers. Traceable fixed cost is $170, which is allocated $90,000 coming from the television division and $80,000 comes from the computers. So the division margin for the company is $100,000. That's how much those two divisions generating to the income of the company. After that, the company itself has a common cost. Why? Because the company has to pay for the accountants, for the CFO, for the what else will be that? Some other admin people, and then you're gonna have a net income. So for this company, the common cost are $25,000, which common cost shouldn't be allocated to any of those divisions because if we decide to eliminate any of those divisions, those $25,000 still gonna stay in the company. And now the company operating income is $75,000. So now let's go with the television division and break down the television division on the even smaller segment to see what's going to happen. Those television division has a two subdivision, one or product lines in this case, regular TV and big screen TVs. When we look at the regular TV and big screen, remember division margin from the television division is 60,000. So whatever we get in here, at the end here, I have to have 60,000. I cannot have any other numbers. It has to be 60,000. Let me see if I can 60. So here, I have to end up with 60,000. Now let's see where we are at this point. At this point, we are that regular screen generating 200, big screen 100, which give us total 300,000 sales. 300,000 sales television, so that's checked. Next thing, variable cost is 55 and 95. So if you look at the variable cost, that's 150,000. If we look, that's 150,000. Variable cost, contribution margin 150. Once we combine 45 with 105, 150. Then we have a traceable fixed cost to those two lines, product lines. One is 45,000 and the other one is 35. As you can see, the product line margin, in this case, will be a regular screen producing 60,000, where the big screen producing 10,000. Altogether are 70,000. But my division margin is 60. What that means? That means I have common cost for the television division itself, which is not affected by any of the product lines that I have. So if I decide to remove the big screen, that common cost for the television division, which looks like to be $10,000, is not going to be affected. So if you run the calculation, again, we're going to see that the traceable cost now to the both production lines are 80,000, not 90,000, which is for the television division itself. So when we break it into small pieces, we're going to see that the traceable cost to those two pieces now are 80,000. And we have the 10,000, which are common only and only for the television division itself. That's most likely will be cost for the manager of the television division, which managing the regular and big screen production. Segment reporting. Why do we need to do segment reporting? Because the segment reporting part of the International Financial Reporting Standards, and under International Financial Reporting Standard 8, we have operating segments, which is required by those standards. Now, the problem is which approach we're going to use. Are we going to use the variable costing approach or contribution approach, or traditional, which is absorption approach? And since we find out the last time when we're doing the absorption versus the variable costing, we found out that the absorption is only recognized and required by the accounting standards. That means the contribution margin format that we're using here, it's not going to be applicable for the application with the International Financial Reporting Standards. So now let's go with which are the problem with the costing and doing all those different segment reporting. Proper cost assignment will be the key here. We can easily forget about some of the cost, or to forget to assign some of the cost to the different processes. Assignment to the segment of the costs that are happening in the company will be crucial. And we have to be careful not to allocate common cost for the entire organization into the segment. Because if you use inappropriate method for allocation the cost among the segment, it might distort the profitability of some of the segments. Let's remind ourselves the value chain. The value chain starts with the research development, going to the product design, manufacturing, marketing, distribution, and customer service. Now, the cost which is assigned to the segment should include all the costs attributable to that segment from the company entire value chain. So everything which is related to a particular segment on any of the value chain in the company should be assigned to that particular division or that particular segment that we prepare in the report. Many companies do not correctly handle the traceable fixed expenses. First, either they may not trace the fixed expense to the segment when they have to, or second, they might inappropriately allocate common cost to the segment, which they're not supposed to do that. The common cost should not be arbitrarily allocated to the segment based on the rationale that, hey, this is a cost, we have to allocate it. Why? First one, this practice may make a profitable business segment look unprofitable. And allocating the fixed cost will force the manager to be held accountable for the cost that they cannot control. If I assign the common cost of the company to my television division, then the television manager will not have ability to control that cost. So for that reason, we shouldn't be assigning that cost. Let's do this quick check now. We have this company, which is Lakeshore, which have two divisions or two segments. They have a bar and they have a restaurant. As we can see, the restaurant contributes 700,000, the bar contributes 100,000. Variable costs are 250 for the restaurant, 60 for the bar, total 310. Then we have contribution margin, both division producing positive contribution margin. After that, we have the traceable fixed costs which are related to any of those divisions. For the restaurant, we have 220. For the bar, we have 26. And then we have the segment margin for the bar, segment bar for the restaurant, 14 for the bar, 230 for the restaurant, total 244. Common cost for the entire company, regardless of what the bar or restaurant doing, is $200,000. Profit that this company generates is $44,000. Now the question is, first question, how much of this common cost, $200,000, can be avoided if we eliminate the bar? So let's say the bar will disappear. Let's make it disappear. I can make it disappear because I have access to the slides here. So let's say we eliminate the bar. How much of the cost we saved? Did they save anything from the common cost? No. So should I eliminate the bar in this case? No. Make sense? So now I have to go back and undo those one. Let's see if this is gonna help me. Undo, undo one more, undo, undo. So I better leave the bar, and I'm leaving it. So how much of the common fixed cost $200 can be avoided by eliminating the bar? What will be the answer here? A, none of it. All right, why? Because the common fixed cost cannot be eliminated by dropping one of the segments. We have to drop both segments, then that common cost will disappear. Now, suppose that the square feet, we're using the square feet, right, of both bar and restaurant, they take some places, and we have the square feet is used to allocate the common fixed cost. if we decide to allocate the common fixed costs, which we're not supposed to do, but let's say we decide to allocate, and we're using the square feet to allocate that cost. How much will be allocated to the bar if the bar occupies 1,000 square feet and the restaurant occupy 9,000 square feet? 20,000. Why 20,000? Because 1,000 plus 9,000, that's going to be 10,000. So 1,000 out of 10,000, that's 20%. Sorry, 10%. So 10% of 200,000 will be 20,000. So Stephen, you're correct. So in that case, we're going to allocate the 20,000. Okay, if some bright mind in this company decide to allocate this common cost to the bar, what's going to happen with the segment? Let's say somebody decide to allocate here 20,000. Currently, the bar generating segment margin 14,000. We are allocating from the common cost 20,000. What's going to happen with the bar? What will be the profit for the bar if we're allocating here 20,000? A loss of 6,000. So if we do this, the bar is going to look like losing money. Now the question is, again, should I eliminate the bar? What would you say? We already answered that question. Shall we eliminate the bar? No. What's going to happen with the 20,000 that's currently allocated to the bar? They're going to stay as a common cost regardless what we're doing. So if we eliminate the bar, what's going to happen? So currently, how we should see this picture, and we're going to see the next in the next chapter, when we're doing the chapter 12, we're going to see the decision rule is if elimination of the segment improve the overall profit, yes, eliminate it. If decreasing it, no, you don't. So let's eliminate that bar. So that will be gone, 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 and this one's gonna go. So with the bar, we're generating 44. Without the bar, how much we're generating now? We're generating 30,000. Did we improve the profit? We're down 14,000. From where the 14,000 came from? The 14,000 came from segment margin from the bar. We lost the segment margin from the bar right away. So that brings us to the question, shall we eliminate the bar? Absolutely not. Don't eliminate it, because if you eliminate it, a restaurant will be the only activity, and all the common costs will be allocated to the restaurant, and the company profit's going to go down with 14, which will be the segment margin that we're losing of elimination of the bar. Now, in order to make, remember, we're having problem with the decentralized system. People are not start working for their own interest. So for that reason, we have to remind them and at the same time to motivate them and encourage them to work in the best interest of the organization. How can we do that? By setting up responsibility centers. Responsibility centers will be part of the organization whose manager has control under certain activities, either cost, either profit, either investment. There are three types of responsibility centers. There are actually four, but in general, we're going to talk about three. Four, because first one will be sales center, then we're going to have cost center, then we're going to have profit center, and then we're going to have investment center. Organization, we're going to categorize the responsibility centers to one of those three types. So let's see first, cost center. What's interesting with the cost center? Managers for the cost center will be responsible only and only for the cost, not revenue, no investment, only cost, not sales, nothing, only cost. Now, profit center. If we think of what means profit, profit means sales minus cost, that means the manager who is responsible for the profit center will have control over revenue and expenses or cost. So he's going to be measured based on the net income of that particular profit center. Investment center itself, that will be interesting because the investment center itself, the manager for those will have access to revenue, cost, obviously income, and they're going to be responsible for the investments as well. So how can we easily example for each of the centers? Now, if we put the sales center will be simply some kiosk on the metro town, which only selling cell phones. They're not the manager or the person who are there. They're not responsible for the cost. They don't care about the cost. They just measure on the sales. How much sales you generating on this weekend. Call center will be the production line or production manager or accountant, which is calculated and measured only by the cost and the cost that he controls. Profit center will be, for example, profit center will be every location of Starbucks, every location from Tim Hortons, every location for any of those franchises or only any of those locations which have a same body. That will be Cactus Club, that will be any of those bars which exist all around the Red Robin, if you put it this way. That every location of those will be profit center. What will be the investment center? Investment center will be the headquarter of all those different stores or different location, different bars. So for example, the investment center will be the headquarter for Cactus Club. The Cactus Club restaurant, any location of the Cactus Club restaurant, manager there, he's going to be responsible for the revenue and cost. So that will be profit center right there. But he will not won't be able to make a decision, should I close this restaurant or not? Should I open somewhere else? That's not his job. That will be done on the headquarter level, where is the investment center. So, responsibility centers. How are we going to do this? We're going to have the company CFO. Company CFO is going to start delegating responsibility to the financial chief officer, legal, general counsel, vice president, and any other operation vice presidents. They, on the other hand, those will be your investment centers and including the CFO. They're going to make a decision where to open new branch, where to open new store, where to expand the company, in which country to go. Should they go with the new product? Should they not go with the new product? Once we decide which division to open, where to open it, then we're going to have those profit centers, which we're going to appoint the manager, which will be responsible for the revenue and expenses. Under each of those centers, profit centers now, those managers, they can appoint somebody who's dealing with the cost and cost only. And those examples for the different type of cost centers within the profit center. So the profit centers will be within the headquarter, which is responsible now for the investing. How are we going to measure it? Obviously, the cost center is going to be measured based on the cost. Profit center based on the net income or profit. Now we're coming to the point of the investment center. How are we going to measure the investment center? Investment center, we're going to have two measurements for that investment center. First one will be return on investment. Second one will be the residual income. Before we continue with this, let's do some freestyle management accounting. Means I'm going to use the Excel spreadsheet again. Let me open one Excel spreadsheet, and I want to do some stuff with you on the Excel spreadsheet. Just give me a second. And I want to show you something so you can understand, and you can come up with the idea with return on investment. I need your activity now, please. So imagine for a second that you have available $1,000. You just have it available, free. You don't need them. You don't want them. You're just thinking of the way to invest them. Imagine you invested them on January 1st, you invested on GIC, which is Guarantee Investment Certificates, for 1 year. You invest in them for one full year. At the end of the year, that will be January 01st. At the end of the year, which is December 31st, you're checking your bank account and you see in your bank account that you have $1,100. Now the question is, how much is your return on investment? First question, let's go step by step. What's your return? How much you generate from the 1,000 that you have on January? How much profit you generate? $100. Okay. So your profit is $100. No questions about it. What's your return on investment as a percentage? If you're generating $100 from $1,000, what's your return on investment as a percentage? So that will be a return on investment is going to be equal to the profit that you're generating divided by the investment. 10%. And Casey is right. It's only 10%. So how we get the return on investment? Well, now on the return on investment, it's going to be equal to let's do it nicely here. It's going to be equal to operating income. Let's merge those one and merge those one too. Choose those one, put it in the middle. Net income or the profit in this case. No question mark here, or slash, or divided by the, yes, it's net, not net. Thank you. Net income divided by, now instead of operating asset, we're going to see average operating, and that's how we're going to end up this formula. Let's make it bigger here. And that will be our formula. Return on investment will be the net income or the profit divided by average operating asset. How much was our average operating asset? In the beginning of the year was 1,000. At the end of the year, it's still 1,000. So how are we going to get average operating asset? 1,000 plus 1,000 divided by 2 is going to be $1,000. And that's how we're going to calculate our return on investment here. We're going to have in this formula, if I copy it here, I'm going to have as a net profit $100,000, and in the bracket here is going to have 1,000 plus another 1,000 in the bracket divided by 2. And that's going to give me my return on investment, which is 10%. That will be equal to this one divided by that one. Oops, now it's going to give me the value because there's no formula here. That's not actual formula. Let's forget this. It's going to be equal to this one divided by bracket 1,000 plus 1,000 divided by 2. And another bracket here just to make it distinctive. And now I can get the 10%. That's how I'm getting return on investment. Now, let's do some tricks with this return on investment. First, what we're going to conclude that return on investment is equal to the net income or operating income divided by average operating assets. That's my formula. Now, that formula is boring, right? It's too easy, too predictable, in other terms, boring formula. So let's make it more complicated. Can we do that? Well, why not? Who's gonna stop us? How can we do this formula more complicated? Very simple. I'm just gonna add something. What I'm gonna add? I'm gonna grab the formula, that's my starting point, and then I'm gonna say, here, I'm gonna add a new element, which will be, I'm gonna get the formula, let's make it here bigger, so everything can stay on the same. I'm gonna grab this, and here, and I'm gonna say time. And I'm gonna time it, multiply this formula by 1. If I do this, am I changing the formula? How much will be 10% times 1? It's gonna be 10%. So am I changing the formula? No, I'm not changing the formula. But now I can play with this. What will be my game? I can say that 1, this one that I have, is equal to sales divided by sales. Is that true? Can I say that? Can I say that 1 is equal to sales divided by sales? Yes. So now, once I said this, now I can substitute in this formula. That will be the tricky part now. Now I can substitute. I'm going to grab this formula now, and right here, I'm going to have average operating income divided by average operating assets time. And now I'm going to get those two. Sales divided by sales. First, I'm going to eliminate this. I'm going to grab this and I'm going to see. Oh, but now I have a new formula, completely new formula. Return on investment is no longer equal to operating income divided by average operating asset, but is equal to operating income divided by average operating assets times sales divided by sales. Furthermore, I'm going to do some mixing this formula now. I'm going to flip these cells going here. So that will become sales. Actually, the opposite. Let's go the opposite. This one's going to go here, and that's going to go here. So first I'm going to have here sales. And here I'm going to move it. Sales divided by average operating asset. And now I have absolutely new formula. In order to make it even more confusing for you, what I'm going to do, I'm going to change the names. How am I going to change the names? Well, this operating income divided by sales is technically my margin. So instead of being operating income divided by sales, that will become my margin. And the sales divided by average operating asset, I'm going to call it turnover. And now I have completely different formula. And what's my formula now? That return on investment is not longer operating income divided by average operating asset. Now it's equal to the margin time turnover. That's with one simple manipulation by timing the formula time one and using the cells. So that's how people in life trick you and tells you that one thing is different to completely different things. So what I'm going to do now, I'm the only one who knows that this terminology. You don't know it. Otherwise, if you know that the return on investment is simply whatever you make divided by the assets that you have, which is obvious, is that one, that's too boring. But if I put it as a margin and turnover, and you start getting confused. And that's what I want, you to be confused. Now you have to come for me for the financial advisors because you don't know what the margin is. You don't know what the turnover is. Or you might forgot. And now I can charge you money. You see, that's how simple we're making simple things complicated. Now we have a ground to charge customer more money. Now the question is, let's go back first to slides and then we're going to come to this back to this Excel spreadsheet. And let's go again. Return on investment again will be the operating income or income before interest and taxes divided by average operating assets, which will be the cash, accounts receivable, inventory, plant equipment, and all the other productive assets. Beginning plus the ending balance divided by 2. Simple average. Now the question is, for those assets, average operating assets, which value should I use? I have on the assets so many values. I have a cost, I have the net value, because some of the assets have amortization or depreciation. So which should I choose? Should I choose the cost or should I choose the net book value? Some people say we use the net book value. Why? Because that actually tells you what's left from the assets, especially for the long-term assets which have depreciation. The other people say no, go with the gross cost method. which eliminate both the age of the computer and everything, age of the equipment and depreciation. And that does not discourage replacement of the old. So somehow people come up with the idea that let's use the net book value for the long-term assets or the property, plant, and equipment, which will be the original cost less accumulated depreciation up to the point of the calculation. And now the trick with the sales divided by sales, in order to come up with a new formula, which is the return on investment is not longer operating income divided by average operating assets, is now return on investment is equal to margin times the turnover. Now question is, how can I increase the return on investment? Three common methods is increase the sales. Next one is reduce operating expenses. Third one will be reduce operating assets. How can I do this? By knowing what exactly affect the return on investment. So by simply looking at this chart, you can manipulate the investors by simple ratio here or simple calculation for return on investment. How? By knowing how the return on investment is calculated. Return on investment is margin times the turnover. So if I increase the margin, return on investment is going to increase. If I increase the turnover, return on investment will increase. How can we increase the margin? By knowing what's in the margin. I have on margin, I have operating income as a nominator and sales as a denominator. So how can I increase the operating income? Because that's the only way I can increase the margin. One way is to increase the operating income. Once I increase the operating income, my margin is going to go up. Now, operating income is sales minus the operating expenses. So if I increase the sales and expenses stay the same, operating income is going to increase. But hold on a second, that sales work as a denominator in my margin and as a nominator in my turnover. So I can simply increase the sales, operating income is going to go up, but the sales is going to go up. So they definitely will be changing the margin. But since the sales are nominated in my turnover calculation, that's also going to be affected. So in overall, I should produce higher return on investment. Let's say we cannot change the sales, then reduce the operating expenses. If I reduce the operating expenses, operating income goes up. Sales are not affected. Margin goes up. That sales are the same sales, so which are not affected. Let's keep the operating assets the same. Then the turnover is unchanged. Return on investment can go up. How can I reduce the expenses? By knowing from where the expense is coming from. If I reduce my office personnel, people who work in my office is going to reduce the operating expenses. That's going to increase the operating income. That's going to increase the margin. That's going to increase the return on investment. The other way is the cost of goods sold. How can I reduce the cost of goods sold? Well, very simple. Remember last week we had product costing, and we're using two different methods, which is variable versus absorption. Which method, when the inventory is increasing, is going to generate the lower cost of goods sold? Obviously, the absorption method. So if I use the absorption method, my cost of goods sold will be less because most of the cost will be absorbed in the inventory. And as long as I'm holding higher inventory than my production, I'm going to carry that cost in my inventory account. Then that means operating expenses are less. That means operating income is high. That means margin is high. Return on investment is high. And if I want to show the signal to my investors that my return on investment, because they're gonna look on the return on investment, because they're the one who wants to invest in the company, the first thing that they're gonna look is return on investment. If I invest that much money, how much I'm gonna get back? And by shifting between the variable costing and the absorption costing, I can make them invest in my company. Or by simply capitalize some of the cost by reducing the operating expenses, increasing the operating income, manipulating the return on investment. On the other hand, what I can do with the turnover, again, sales, not much again because the sales going to be affected here. But let's see what we can do on the average operating assets. Since it's denominator, the only way to increase the return on investment is to decrease that operating assets. How can I decrease the operating assets? But knowing what's on the operating asset. What's on the operating asset? They have cash, current assets, and have long-term assets, which is property, plant, equipment, and other assets. I have cash, accounts receivable, inventory, plant and equipment, other expenses. All together, it's going to give me average operating assets. Now think about it and tell me, by seeing what you're seeing here, that they have cash, accounts receivable, inventory, plant, equipment, other assets, what would be the easiest way to reduce my assets? How can they reduce this number? Let's see what you can come up with. How can I reduce any of those assets in order to improve my average operating assets, to make it lower, to increase the turnover, and to increase the return on investment? How can I do that? Give me possible scenarios. All of you already finished 11-10. I already know that. Some of you even finished 12-10. So give me possible scenarios with debit and credit, which going to help me to reduce my current assets. So obviously I need any of those assets to be on the credit side to go down. What I should debit? What should I do? What kind of activity I can do in the company to reduce the assets or operating assets? Any ideas? No one wants to talk? Okay. So let's think about it. Sorry, what was the question? The question is, give me activity in the company or any activity, any transaction, any event in the company which is going to help me to reduce my average operating assets. Which you see the assets are cash, accounts receivable, inventory, plant equipment, other assets. What activity or what transaction or what event in the company is going to help me to reduce those operating assets? Reduce spending. That's going to increase the cash. If I reduce the spending, that's going to increase my cash. That means average operating assets is going to go up. That means turnover is going to go down. Return on investments goes down. That doesn't work. Accounts receivable collection. Okay, let's think about it. If I collect the accounts receivables, what I'm going to get? I'm going to get cash. So I'm going to flip accounts receivable into cash. There's no change on operating assets. If I sell my inventory, then I'm going to have accounts receivables or I'm going to have cash, which again, it doesn't help me with the assets. Good idea, Elena, but something moving from one to another. Sell their property, plant, and equipment. If I sell the property, plant, and equipment, I'm going to get cash. Still doesn't help me here. Withdraw money. Okay, accounts payable. Okay. Yes, if I use the cash to pay my accounts payable, then I'm reducing the assets and reducing liability. That's going to help actually. If I withdraw money, yes. If I withdraw the money, if I pay dividend to the shareholders, yes, that's going to reduce the cash. That's going to reduce operating assets. That's going to improve the return on investment. Yes, those two work. Interest doesn't work. Dividends, yes. Boost the profits. It's going to hit me on the operating income, yes. But then the sales, yeah. But we're talking about operating assets. We're chasing the operating assets. If I boost the sales, assets going to go up. That means more cash for me or accounts receivables. So that's not going to help. Withdrawal is going to help. Paying the accounts payable is going to help. Or dividend. Okay, good. So let's keep going with this. How can we do this? Obviously, how can I make, now the question is, you as an accountant, one day you have to think, how can I make people, random people, to invest in my company by showing them higher return on investment? How can I show high return on investment? By simply debit and credit. If I know which account to debit or give the employee raise, yes, that's another thing. But if I give the employee raise, what's going to happen? My cash is going to go down. My expense is going to go up. So think about the other side. So now I'm gonna, it's my work, but you have to run the numbers and to see what the effect is, because automatically the expense is gonna go up. If the increase in the expenses um, is countered by high sales now because the people are more motivated, then it might work because that's going to increase the operating income, right? But then if you increase the sales, then more cash is going to come in the company. So that's the thing that you have to think. There's so many things you have to. They're so correlated. There's a lot of correlation here, and you have to be smart in order to get the right, to push the right buttons, to get the right result. In order to show the investors whatever they want to see. If I want to make my company unattractive, what I'm gonna do? I'm gonna keep the cash. I'm not gonna give in dividend. Then the return on investment will be lower. But I don't want anyone to invest in my company. I don't want somebody to take over for a company. If I want to sell the company, I'm going to increase the return on investment. How? I'm just going to debit and credit here, show high return on investment, come and buy my company. By the time you figure out what I did, too late, you already bought. So let's see how this is going to work. This company have the following things. They have operating income of 30,000. I'm going to copy this one and going to transpond them to the Excel spreadsheet, and I'm going to move to the Excel spreadsheet. They have operating income of 30,000. Then they have average operating assets of 200,000. Then they have sales of 500,000. And the last thing that they have operating expenses of 470,000.
God, this is like he's fucking. Do you remember Zach's dad? Like that. That's what I'm.
Now the question is, How much is our return on investment? And let's go and calculate it now. I'm ready with the Excel spreadsheet, and I'm gonna post it right now to you. I'm gonna stop sharing this and I'm gonna move to Excel spreadsheet. So I have the information. I have let's get this formula here. That will be mostly the formula that we're gonna use. We're gonna use this formula. So what do we have? We have operating income of 30,000. Let's put it right here, 30,000. Then we have average operating assets for 200,000. Then we have sales of 500,000. And we have operating expenses for 470,000. See, if the operating expenses 470,000, then makes sense the operating income to be 30 because 500 minus 470, that's exactly 30,000. So that's matching the operating income that we have here. Okay, great. We have our numbers. Let's put the dollar sign in front. We have the numbers. So return on investment. Let's apply to the formula and see what's going to happen now. Again, I'm going to grab this formula, gonna paste it right here and keep working with this formula. So first I'm gonna have operating income is 30,000. Sales are equal to 500,000. Then I'm gonna have sales here 500,000. Maybe I should push this one a little bit this way. This one's gonna go from here. I'm gonna move it here. And then I'm gonna have all this available for myself. 30,000 here and 30,000 here. And now the sales are 500,000 and average operating asset is equal to 200,000. Now I can get the numbers, correct? And my numbers here will be by using this formula now. It's gonna be operating assets gonna be actually no, my numbers, which will be the margin and I'm chasing my margin and my turnover. So the number so that I need is gonna be the first number here was gonna be, let's merge those cells. That's gonna be 30,000 divided by 500, and that's gonna be 0.6 or 6%. And the turnover, it's gonna be a number. Now the first one will be the percentage because the operating income comes from the sales. Sales are 100%. So now we want to see how much of the sales left in the operating income. So only 6% of our sales coming to the operating operating income. Now the other one is the sales divided by average operating assets. That means how many times I have my sales in the average operating assets. So that will be strictly a number, which will be 500,000 divided by 200,000, so 2.5 times. And then my return on investment in this case will be simply 6% times 2.5 or 15% in this case. And that's how we're calculating the return on investment when let me delete those rows here. So you can see all together with the information and the formulas. So when our operating income is 30,000, average operating assets 200, sales are 500,000, operating expenses 470, our return on investment will be 15%. If we keep going, that's how much it's going to be. Now, what's going to happen? How can we improve this return on investment? Now we have to start doing some changes. So let's go to the slides and see how the slides continue now. Once we apply the formula, we're going to see that our return on investment is 15%. First thing what we're going to do. This manager was able to increase the sales to 600,000, while the operating expenses increased to 558. Company operating income increased to 42 because 600 minus 558 will become 42. There's no change in the average operating assets. Let's recalculate the new return on investment. So let's flip back to the Excel spreadsheet and see what's going to happen if this happens. I'm going to copy this directly and I'm going to post it below. So what's happened? We were able to increase operating income. It's going to be equal to the sales minus operating expenses. So our sales become 600,000. My average operating expenses become 5552, 123, or 558. Let me double check on the formula. 558. I was wrong. It's 558 here. So what's happened is my operating income become 42. So in this case, what's happened with my operating return on investment? Original scenario, return on investment is 15%. Now, once we increase the sales, what's the increase in the sales here? We can easily change increase compared to the original scenario. So in this case will be this one minus operating expenses. So we have increase on the operating income with $12,000. Then we're going to have no change in the average operating assets, stay the same. Increase in our sales with $100,000, and that give us increase in the operating expenses with $88,000. So if we achieve this, then our return on margin is going to become from 6 is going to move to 7. And since the sales increasing, now I'm going to have my sales from average operating assets that I have. I'm generating 3 times sales. So that's going to boost my return on investment to 21%. Simply by increasing the sales or operating income with 12,000. In order to achieve, again, we have to increase the sales with 100, operating expenses jump with 88. So let's see the other scenario here. In the first scenario, again, when we run the calculations, we're going to see the return on investment increase from 15 to 21%. Next thing that this manager is doing. Manager was able to reduce the operating expenses, only to reduce the operating expenses with $10,000 without affecting sales or operating assets. Which is obviously is going to increase the operating income to $40,000. Let's see what's going to happen if we do this. I'm going to go back to the Excel. And I'm going to keep going with this calculation. I'm going to copy this and going to post it right here. Now, what's happened in this case? We still in the original scenario. In comparison to the original scenario, we are able to reduce the operating expenses with 10,000. Now, let's see. That will be this one minus this one, and then we're going to calculate all the numbers here. So we're reducing the operating expenses with 10,000. Instead of 470, they're going to be 460,000. which have to, now this non-operating income is gonna be sales minus operating expenses. So what's happening is my operating income goes with 10,000, operating expenses go down with 10,000. How this gonna affect my return on investment? Now, operating income is 40. Sales are the same. So I shouldn't expect any changes in the turnover because compared to the first formula, turnover is 2.5. I'm not changing the sales, I'm not changing the average operating assets, so the turnover is 2.5. But my return on investment from 6% original scenario moved to 8%, which give me the return on investment of 20%, people. By simply reducing my operating expenses with $10,000. I'm generating, as you can see, 5% increase on the return on investment. That's how powerful the expenses are in this formula. That's something that we should think about if we need to increase or show increase the return on investment. Now let's keep going with this. And let's go back to the slides. And the next thing is, once we read the formula, again, we're going to see the return on investment jump to 20% by simply reducing the expenses with $10,000. Next scenario, the manager was able to reduce the inventory by 20,000 using just-in-time techniques without affecting sales or operating expenses. Now let's go to our Excel spreadsheet and just incorporate that reduction of the assets with $20,000. How this is going to project to our calculation and what will be the effect on return on investment. So I'm going to grab this part here again. Put it here. Now that increase is going to be equal to this one minus the original scenario, which is all over here. Let's get those calculations now. Now what we said, the operating expenses stay the same, 470. We're reducing only the average operating assets from 200,000 to 180,000 or to 20,000. That's our increase. 20,000 average operating assets. Where is that gonna hit us? Obviously, there will be no change in the return on investment compared to the first formula. Return on investment still, sorry, no return of the margin. Margin still gonna be 6%. But my turnover now instead of 2.5 is gonna go up. Why? Because my denominator instead of being 200 went down to 180, and now I can see the change in my turnover to 277 compared to 2.5, which increased my return on investment to 17%. Let's see, it was a difference 16.67. So I have 1.67% increase my return on investment by reducing my assets with $20,000. So which one is more powerful? Return on the decrease on the expenses or decrease on the assets now? That's one thing that we should ask ourselves. And obviously, decrease on the operating expenses with $10,000 has a way more effect than decreasing the average operating assets with only with 2 times more than the increase of the expenses in this particular scenario. So let's go to the next one. There's one more scenario here. The manager of the company invested $30,000 in the piece of equipment, so that means assets increase, which increased the sales by 35,000, but increased the operating expenses with 50. So let's go to our Excel spreadsheet and see how this is gonna affect our numbers now. Again, copy and paste this one and compare to original scenario, which original scenario is this one minus all the way on the top, which is here. So what we said, average operating assets from 200,000 moved to 230. First, assets increase with 30,000. Then we have increase in sales with 35. So from 500, they moved to 535. But the expenses goes up as well with 15,000. Instead of 470, become 485, 1, 2, 3. So I have increase in the operating assets with 30, increase in sales with 35, and I have increase in the operating expenses with 15, which give me increase in my operating income with $20,000. So what's going to be affected? Obviously, margin is going to be affected, and the turnover also going to be affected. Margin, as you can see, in this case, going way higher than the original. On the original scenario, we have 6%. Now my margin jumped to 9% of this scenario. Turnover, however, went down. Why? Because I increased the average operating asset with 30,000. So the turnover went down. But return on investment now is 21.74. That's how easily can move to one scenario to another scenario on the return on investment, and you to improve the internal investment by applying different techniques. Let me put everything in different colors. So later on, when you're checking the answers, you can see which one is the original, which one is the other one. That's with the return on investment. Let's go back to the slides. And once we run, we're going to see that 21.8. If we round the numbers, we're going to go to 21.8. Now, the criticism against return on investment is in the absence of the balance scorecard. The management may not know how to increase return on investment. Or without this chart here, you want to know what to do to increase the return on investment. Manager often inherit many committed costs which cannot control. So that means they don't have much control over the expenses. Why? Because those committed costs coming from the previous manager. And manager which are evaluated on the return on investment may reject the profitable investment opportunities. So how can we fix this problem? By adding a new performance measures, which is residual income. Residual income will be another performance. Residual income simply is going to tell us where we are compared to where we're supposed to be. In other words, let's go back to the Excel spreadsheet, and I'm going to show you in the Excel spreadsheet how this exactly is going to work. That worksheet is going to be return on investment, and the next one obviously is going to be residual income. So for the residual income, I don't need all this calculation and all those formulas. So I can simply just erase everything. Let's go back to, and we are back to our GIC example. With the 1,000 that you have available, now you're investing it for 1 year on GIC, but those GIC now give you 10% return. You already know how much your return on the GIC will be, 10%. On December 31st, you're checking your bank account and you're finding in your bank account $1,300. Now the question is, how much is your residual income? Before we answer that question is, if you invest 1,000 on 10%, how much you expect at the end of the year? How much should be the total amount that you're expecting at the end of the year? $1,100. How much you see? 1,300. So how much is your residual income? Or how much more you get compared to what you're expecting? $200. So the $200 we're going to represent your residual income. So what will be that? The residual income in this case is going to be simply actual operating income minus, and now in the brackets I'm going to have average operating assets time required rate of return. And that's how we're going to get the residual income. Now, residual income, I can see it because I'm combining it now with the total. But if I go directly, I can easily calculate that my profit here, or operating income, let's put it operating income, in this case is what they have in the beginning minus what they, at the end minus what they have in the beginning. My actual operating income is $300,000 if I call the profit on the investment, and my expected was this one minus that one. And so my residual income in that case will be what I get minus what I expected. It's still going to be $200. There will be no difference. So let's go back to our formula here in our slides. So again, residual income will be actual operating income minus average operating assets time required rate of return. Everybody requires something. The question is, do you get it or getting more or getting less? Now, this computation is different than return on investment. And as you can see, return on investment has nothing to do with this. Residual income measures the operating income earned less the minimum what you required. If the minimum that you require is 10%, then means that you earn way more. So let's see this thing. This division has the following information. Let's go back to the Excel spreadsheet. And we have this division here, which has the average operating asset of $100,000 and is required to earn 20%. In the current period, the division earned $30,000. How much is the residual income? Well, again, the residual income is going to be actual income minus the average operating asset time required rate of return. This company required rate of return 20%, and the assets is $100,000. Now, how much is the residual income? Well, with the formula here, if we have to apply the formula, we're going to get that the actual is 30,000 minus what's required. I'm required from the 100,000 that I have. I want to get only 20%. So my residual income should be how much you're getting. 10,000. Make sense? Everybody comfortable with this? Okay, let's keep going then. Where were we? We are on this question here. So how we gonna get this? First, we're gonna calculate how much we want. We want 20,000. How much we get? 30,000. 30,000 minus what we want, it's gonna give us the residual income. Now, the residual income now is going to encourage the managers to make a profitable investment that otherwise will be rejected by the manager if he using only return on investment. So let's see how we're going to justify this. We have this question here, and let's move to Excel spreadsheet and try to solve it on the Excel spreadsheet. I'm going to move it to the new worksheet here, and I'm going to go questions. This one I don't need. This one also I don't need at this point. And none of this I need. But I have the picture of the question. This division has the operating income of 60,000. Average operating asset 300. Required rate of return of the company is 15%. What's the division return on investment? So what I can do is I can simply say that I have the operating income, which equal to, let me see if I can put it this. Since I don't have, this is completely new worksheet, I can manipulate the cells the way I want it. So operating income in this case is 60,000. And let's put it this format. I have the average operating asset of 300,000 and my required rate of return is 15%. How much is my return on investment? Is equal to question mark. How we calculate it? Well, we already know that the return on investment is equal to operating income divided by average operating assets, which coming from here. The very first formula without manipulation of the formula that we did later. So that will be this formula here. Let's move the formula right here so we can see it. So we're going to calculate it that return on investment in this case is going to be simply operating income divided by average operating assets is going to be 0.20, but I want that number as a percentage. So we can easily see that this is 20%, which the correct answer will be D. Back on the slides, obviously the correct answer will be D. How are we going to calculate it? Operating income divided by average operating assets. So now, this division has the operating income 60,000, average operating assets 300,000. If the manager of the division is evaluated based on the return on investment, is this manager is going to make investment of $100,000, which will generate additional operating income of 18,000 per year. Now let's get this calculation here, or this scenario, and let's flip it to the Excel spreadsheet and see what we can get from there. If I push it a little bit down, I'm going to get that this information here. I still have this scenario. So My operating income is 60. My average operating assets 300. I don't know what's the required rate of return. That's not given. Now, what I can see is that currently this division generates 20,000. Now, if this manager invests another 100,000, that 100,000 is going to give him additional 18,000. What's the return on investment on this particular project only? That will be 18%, correct? So if this manager is evaluated on return on investment, which current return on investment is 20%, is this manager will be willing to invest in this project? Most likely no. Why? Because the return on investment on this particular project is 18%. Now, even if we combine all those together, if we, let's say, we combine all those two together, we're going to have operating income of 60 plus 18, and assets going to be 300 plus 100. Even in that case, let's see how much is our operating income. Return on investment dropped down to 19.5% compared to 20. So that project by itself or combined with what we have definitely will be not desirable by the manager. Why? Because the return on investment is going to drop down. So obviously the answer here will be no, because the project itself give you only 18%, but combining with the overall company is still going to be below the 20%. Now, what's going to happen if the company require only 15% then? Would the company want the manager to invest in that project now? Yes. Why? Because if I want only 15%, this project clearly give me 18% that we saw. So in this case, yes, we're going to go for it. And that's a justification of the answer that we generating 80%. We already saw that one. Now the question is, this company has, again, operating income 60, 300,000. Required rate of return is 15. What's the residual income? Let's go and check the residual income on our, we have that information in our Excel spreadsheet. In here, as you remember, required rate of return is 15. Return on investment is 20. Now the question is, how much is the return on investment? If I pause the formula here, so we can see the formula. Now our return on investment here, our residual income here is going to be equal to how much we're generating? We're generating 60,000. Correct? We're generating 60,000 minus in the brackets what we're going to have operating assets time what we want only 15%. So our residual income in this case is going to be $15,000. So how much will be what will be the answer here? What the residual income? Residual income is going to be $15,000 here. How we calculate it? Again, I'm getting 60. I want only 45. 45 comes with the 15 that I want. From the assets that I have 300,000, that's only 45,000. So residual income is $15,000 in that case. Now, if the manager of this company is evaluated based on the residual income, will she want to make investment of 100,000 that will generate additional operating income of 18,000? Well, in that case, having in mind that the company only requires 15%, that means here we're going to generate positive residual income of $3,000. So yes, the manager will want to do that. Because the residual income is going to be $3,000. So now, what are we going to do with this? I didn't want that one. Residual income approach has one major disadvantage. It cannot be used to compare performance of division of different size. What that means? That means simply that if we have this information, we shouldn't use the residual income. So let's see this one. I'm going to flip it, all the information to Excel spreadsheet. And let's do it there so you can see the logic here. I'm going to flip this worksheet and I'm going to label it question 2. Erase everything from here, including this picture and everything that I need. And this one as well. And now I'm going to try to post that information here. Let's see if this is going to work. Okay, it didn't work, but at least I have some information. Let me see if I can do some other tricks here. Yes, I'll be able to do some other tricks. So that's my information as a picture. That's great. But let's post it as Excel spreadsheet now. This is as Excel spreadsheet, and I have two. I have the retailer and I have the warehouse. The only thing that I have to increase is the numbers. And now we have the whole information on one Excel spreadsheet. So this company has two divisions, retail and warehouse. Let's make it bigger. They have operating assets of the retailers, 100,000. Operating assets in the warehouse are 10 times more, 1 million. Required rate of return is 20%. So both have the same required rate of return, 20%. If we check the minimum required rate of return is 20,000 from the retailer, 200,000 from the warehouse. Annual income from the retailer is 30,000. The minimum required rate of return, we already get it. It's negative of this amount, 20,000. And here is negative of this amount, or 200,000. So residual income the retailer, as you can see, is 10,000. Warehouse is 20,000. The question is, if you have money are not an object in this case, in which one of those you're going to invest? If you have unlimited cash, cash is not your problem. On which of those you're going to invest? In the retailer or in the warehouse? As you can see, the residual income on the wholesale is way higher than the retailer. Weight say retailer. Why? Why retailer? Return on investment is high. So what was the formula for the return on investment? Let's remind ourselves, what was the formula for the return on investment? Return on investment formula simply says that return on investment is average operating income, operating income divided by the average operating assets. So if I have to run this return on investment, I'm going to get here return on investment is, I'm getting 30,000 out of 100,000 operating assets, or I'm getting 30% return on investment here. And my return on investment and the warehouse is 22% only. And that justifies the problem that we have when we comparing two divisions with the different operating assets. So the residual income in this case is not a good indicator. We have to go with the return on investment. Once we calculate the return on investment, then we're going to see which one is the profitable. All right. Again, once we do the calculation, we're going to find out that return on investment on the retailer is 30% compared to the return on investment in the warehouse, which is only 22%. Criticism against residual income. Again, residual income is based on the historical accounting data, which may be inflated or can be manipulated. Return on investment, residual income here. Residual income does not indicate whether the earnings should be or should not be. Calculating residual income require numerous adjustment for the accounting income, which increasing the cost of the preparation of the information. And residual income does not incorporate important leading non-financial indicators. Which are those non-financial indicators and how we're going to see those non-financial indicators? Balance scorecard. So since one of the criticism against residual income that it doesn't incorporate non-financial indicators, we're going to use the balance scorecard now to include those non-financial indicators. What is balance scorecard? Balance scorecard is a tool or technique which help us to translate or help management, but us, I'm saying us because you're the managers, help us to translate the strategy of the company into the performance measures that can be explained, understood, and accepted by everybody in the organization, from the management to the employee. Again, we're going to translate the strategy. Which strategy? Strategy of the company. What was the strategy? The strategy was a game plan how we're going to attract the customers by differentiating ourselves from everybody else on the market. So that's why it's important we to understand what the strategy was. Again, how we gonna attract the customer by differentiating ourselves from everybody else on the market. And that's how we're choosing the strategy. Now we have to explain everybody else in the company, employee management, CFO, through the balance scorecard, what's our strategy is. We're gonna have 4 perspectives here, or performance measures on the 4 perspectives. We're gonna have financial, we're gonna have a customer perspective, We kind of have internal business process perspective, and we kind of have learn and grow perspective. What we're going to find under the financial perspective? Let's go first in the financial perspective, and then I'm going to talk about the how we're going to integrate. Or maybe we should start with integrating. How we going to integrate? How we going to use this balance scorecard? Again, on the financial perspective, we're going to chase how the financial performance improve in the company by using what we're using. Customer perspective will be what is the customer satisfaction from the product that we're delivering to the customers, and how the customer recognize our product compared to all the other products on the market. Internal business process going to answer the question is our process that we're using currently can deliver the value to our customers so the customers can choose our product instead of all the other products which are on the market. And if we find something that we don't know, we have to constantly maintain our ability to learn and grow in order to provide something that the customer wants on the expectations of the customers in order customer to keep choosing our product instead of all the other products which are available on the market, which is going to improve our performance. So now, everything comes with the mission, vision, and the strategy which is chosen by the company. Why the company has to choose the mission and vision and the strategy? Because the company has a goal. What kind of goal the company has? Usually those are financial goals. Everybody who start the company, his goal is, I want more profit. If you ask Starbucks shareholders what they want, they only want one thing. I want profit. Do they want customers? But from where the profit comes? From the customers. So if I want more profit, indirectly, what do I want? I want more customers. So if I tell my customers that the only thing, listen, my dear clients of Starbucks, the only reason why I'm doing all those promotions, the only reason why I'm giving you all those cups with the fancy pictures and all the sales that I'm doing, the only reason why I'm giving you free coffee on your birthday is just to make money from you. If the Starbucks tell you this, would you feel better? Would you choose them as a product? Most likely not. But that doesn't change the fact that the shareholders of the Starbucks, that's exactly what they want. Now, if that's our mission and vision, and that's our strategy, we're not going to sell anything. So what we have to do? We have to wrap our desire to make more profit in the fancy way and to sell it to the customers. And then Starbucks comes with the mission and vision, which is customer oriented. Our mission is to provide super organic, super healthy coffee to our value customers, which every time when they taste it, it's going to bring the dream of being free and wealthy. They're never going to tell you that the only reason I'm selling you coffee is to make more profit from you. In contrary, they're going to tell you that through my coffee, I want you to feel healthy, wealthy, organic, and everything else. Just pay me the money and get the coffee. So that's how we're wrapping the mission and vision. Mission and vision has to be strictly oriented to the customers. We have to attract, again, we have to differentiate ourselves from everybody else on the market based on the strategies that we choose. Now, once we see what kind of techniques company using, we can easily guess what the strategy is by knowing that the strategy can be the bold strategy, which is on the both sides is value leadership, which producing the high quality unique products for which they're charging premium price, or cost leadership, which is highly effective. They eliminate the waste, they cut down the cost in order to generate the profit. It doesn't mean the product is less quality. Don't get me wrong, it might be even higher quality, but that's how they're achieving it. So, we're going to wrap up in the mission and vision, and we're going to ask ourselves, what customer do want to serve, and how do we going to win and retain the customers? Everything is about the customers. Why? Because the customer is the one who's going to pay the revenue. There's no other options here. That's how we're going to differentiate ourselves from everybody else. How are we going to do that? Through internal process. And we're going to find the internal process, which one is the critical points, which providing value to our customers. How we know the critical point of providing value to our customer if you don't know our customers and we don't know what actually creates value to our customers? That will be hard. So where are we going to start? We're going to start from the customer survey, to extract as much as information possible from the customers, what they want, when they want it, how they want it. Is it going to be in the raw version? Is it going to be, are we going to chew it for them, or how exactly is it going to be? Once we find out, we're going to adjust our internal process in order to provide to the customer exactly what they wanted, exactly when they want it, so they can do with the things that we're providing what they want to do. And our thing will be better than everybody else on the market. And once we get the customer, we try to retain that customer. How are we going to do this? By constantly learning and grow. Maintaining our ability to change, to improve, to adjust, to understand the customers, to put a new technology in place, to artificial intelligence now is the hot area. Why? Because we're learning and grow. What we're learning? We're learning the information from our customers. We're learning, constantly learning. Improving our internal process, make the customer happy, they pay us money. The money is going to come by providing value to the customers. Now, let's go back to the balance scorecard. Balance scorecard, when you look at the four perspectives, only one is financial. Only one tells you how much you generate. Unfortunately, the financial perspective is a lagging perspective. What means? It just tells you what happened. It doesn't tell you how to change it. It just tells you, last year, your sales were this much. Your expenses are this much. Your operating income was that much. But this is something that based on what already happened. How are you going to change it? By simply looking at financial perspective, you're never going to find out. So what you have to do, you have to look for the non-financial perspective, customers. From where the revenue comes from the customers, what the customer want, how happy they are. Are they happy? Are they not happy? What's the level of satisfaction? Are they going to keep doing with us, or going to go somewhere else? If you want to retain those customers, we have to, if current internal process create value to the customers, and that customer providing steady revenue, then we're fine. But if that's not the case, then we have to change. Once we find out what the customer wants, we have to change internal process and adjust to the customers. Otherwise, there will be no money. But how can we adjust the internal process? By constantly learning growth. Now, how can you interpret this balance scorecard in your perspective, in your personal life? Very simple. Those of you who are working, what you have to do? At the end of this week or the 15th of the month, what you have to do? You have to go to your bank account. What you're going to see in the bank account? The financial perspective. Or how your employer value you. And you're going to see amount in your bank account. Now you have two options. Option one, you like what you see. then keep doing what you're doing. Option 2, you don't like what you see. Then what you should ask yourself, from where this money come from? Keep looking closely on your bank account, and you're going to see who actually sent you the money. And the money usually comes from the customer. Yes, we call it employer, but in fact, that's your customer. That's the institution, or that's the person, or that's the individual, or that's the company that you're providing your services. And they choose you among all the other competitors which are in the market. But they choose you. So now you have to ask yourself, if I don't like what I'm seeing from financial perspective, where should I look? I should look my customer. What the customer want? Is the customer happy with my performance? What else I can do for my customer? What the customer wants? What the customer need? How can I increase the value that I'm giving to my customer? Because if I don't change the value that I'm providing my services, my customer tells me, I'm sorry, but I choose another product or another service provider in our case. So once we find out what the customer want, how the customer want it, what brings value to the customer, what we have to do with the capacity that we have, we can see with the capacity that I currently have, with the knowledge that I have, with the skills that I have, can I provide that additional value to my customer so I can make him happy, so he can give me a raise next um, salary review. If you don't have it, then what you have to do, learn and grow. Once you learn and grow, implement an internal process, provide it to the customer, and on the annual review, what you have to do. Don't go to the annual review and tell your employer, you know what, I think you should increase my salary because the life cost of the life increase. Not gonna work. So what you have to do, you have to prove that you created value for your customer. That's how simple it is. Starbucks, again, think about Starbucks. Starbucks doesn't come to you and say, the only reason that I like you is because you pay me a premium price for the coffee that I give you. I know the coffee is lower quality than McDonald's, but just keep paying me $7 because I want your money. They don't say that. So for that reason, when you go to the annual review, don't say that as well. Go to them and say, last year, I learned this software. I learned this. I learned this. When I learned those new skills, I implement it in my day work. I become more efficient. I become faster. I become this. That helped me to provide additional reports, help me to do this, help me to do that, to become more efficient, more fast, give me ability to provide new things for you, which when you get it, that bring you this value and this value and this value and this value. And by doing all those things for you, I create these opportunities for you, which you're benefited. So I strongly believe that all the things that I'm doing for you and all the things that I keep doing for you and additional work that I'm taking, which creating extra value for you to compare to what was value before, I believe there should be adjustment to what I'm providing to you, to what you're giving me. And then I can clearly tell you that your employer is never going to say no. Why? Because again, you're using the balance scorecard to ask for increasing your remuneration. How? By proving that you learned something, improving your internal process, create extra value for the customer by adjusting yourself to the customer needs, which creating a way more value for the customer than he currently contributes to you. And then the customer will be willing to pay a little bit more. So if you want to increase it $5, you should ask for 10. The customer say, what, $10? No, 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 5. And you get what you want. If you want $2, ask for 5. Then you say, $5, that's too much, $2. Then you get what you want. But that's how you're doing negotiation. That's how you're selling your product. That's how you differentiate yourself from every other people who are sitting there and providing the same services. That's why the employer chooses you, because he saw in you something unique, which creates value for that particular customer. Don't forget who the customer is. Adjust yourself to the customer needs by changing the internal process or keep internal process the same. And if you have to change it, learn and grow, implement it, make a customer happy, financial is going to come. Trust me on this. If you implement this learning and grow internal process, customer relation, financial is going to come. There's no way not to come. You can see it in the business. That's why people buying a Louis Vuitton bag. That's why people buying Chanel bag. Did you ever heard the Louis Vuitton having Christmas sale? You're never gonna hear it. Do you hear that Chanel has a Christmas sale or has a customer appreciation day? Or on the date of your birthday, they're gonna give you 10% discount. They're not giving discount. Why? Because they already have you as a customer. I know that whatever I do, you're still gonna come to me. Why? Because I'm providing something which is exceptional. Not to mention that coming with a life warranty. And that's how you achieving your financial goal, which financial goal now is to increase your profit or to create a higher contribution margin, whatever it is. But that's how you're implementing mission and vision into the process that you have through all those perspectives. In order, again, everything is oriented and related to the customer. So on the balance scorecard relies on the financial, non-financial measure. Now, financial measures are, again, luck indicator because, again, just tells you what happened in the past. How can you change the past and move it towards the future? Non-financial indicator is going to tell you that. Top managers are originally responsible for, again, for the financial performance measure, but that's not the one that we're looking for. Non-financial measure are more likely to be understood and controlled by the lower level management. So the entire organization should have a balance scorecard. Each individual should have his own balance scorecard. On top of that, every human should have a balance scorecard. I have at least 3 balance scorecards. 3 balance scorecards. Because for different activity that I'm doing, I have different customers. When I'm teaching, who is my customer? Right now, I'm providing you a service. Who is my customer? Can you guess? You're my customer. So what do I have to do? On one day, at some point, which is coming at the end of the semester, you're gonna provide a customer satisfaction survey, which is called course evaluation. Then I have to explain my other customer, which is my employer, which is the school, how much value I created to you as a customer on one side and school as another customer on the other side. So I have 2 balance scorecard up to this point. Balance scorecard as a teacher and balance scorecard as an employee. And the customers are different. The third balance scorecard that I have is at home. And I can simply tell you what's happening. Imagine this. After the class today, we're going to finish around 9 something. I'm going to have to do some other stuff and then I'm going to go home. Imagine I'm going home at 11 o'clock. Walking in the home, the lights are shut down, everybody's sleeping, no dinner on the table. What that means? Customer is not happy. So what do you have to do? Understand, start learning about the customer, what the customer needs are, what the customer wants, what's the customer satisfaction. How can I improve the customer satisfaction? How can I create more value for the customer? Then I'm going to look with all the things that I have and skills and abilities. Can I provide the new or what the customer wants? If no, I have to learn and grow. What I'm going to learn? I'm going to learn about my customer, how to make it more happy, what kind of techniques to use in this. How would I know that everything that I learn implemented in my internal process actually affected my customer? Very simple. Next week, when I have the lecture, when I go at 11 o'clock, if the light is on, if somebody waiting for me in the living room and the dinner is on the table, that means customer is happy. That's how simple it is, people. Obviously, financial perspective is going to missing here, but that's how you can adjust yourself to the situation by always trying to create a value for the people around you. And trust me, if you do that, they're going to bring back that value to you. So don't focus on what you want. Focus on what the other people want. Give what the other people want, and then you're going to get what you want. If you only focus on what I want, or if I'm only focused, if right now I'm teaching you with the only mind, with the only thing in mind, what I want, I'm never going to get anything. But if I'm focused on my customers, to give what my customer wants, eventually, indirectly, it's going to come back to me. That's how we should look at all this. That's why I like this balance scorecard. That's why in the advanced managerial accounting, if you catch me there, we're gonna do assignment on the balance scorecard. And there's a case that we have to do on the balance scorecard. And trust me, the balance scorecard is not managerial accounting, it's more the governance, strategy and governance. But again, in order you to be successful as a manager, you have to have a strategy. You have to understand how to approach the situation, how to deliver what the people want. Because again, you only get reward when you deliver the right thing to the right people. And then you're going to get what you want. So the personal balance scorecard should contain measures that can be influenced by the individual who is evaluated and support the measure in the overall balance scorecard. So the balance scorecard should have measures that are linked together. If I do this, what's going to happen? If I improve one performance, then what's going to happen? If I learn this, how this is going to affect me in the internal process? What kind of ability is going to give me to provide new value to the customers? How the customers probably is going to react? You cannot always talk about the customers because but at least you have ability you to control the situation up to the customers do it. The balance scorecard lays out the concrete action to attain the desired outcome. So incentive compensation should be linked to the balance scorecard. That's what I'm telling you. If you want you to have successful annual review, implement the balance scorecard in your review. Start from the bottom, go to the top. The top is the amount that you want. Example for the balance scorecard will be this company, which is a Jaguar. production of the cars, they're going to have financial. They want profit, contribution per car, and number of the sold car. Who's going to give the contribution per car, going to give him the profit. Now, but the number of sold card also is going to affect the customers. If I selling more, that means I have happy customers. And I'm going to chase the customer satisfaction and increase the satisfaction by providing more options in my cars. Business process will be number of options available and time to install each option. Learning and grow will be employee skills to install those options and their ability technical skills. So how we should look like? If I increase the skills of my employee to install the options, then I'm going to be able to provide more options in my car. And that's going to reduce the time to install each options. If that happens, the customer is going to get those options faster. They'll be happy. The other thing is, if the customer is happy with the new options and the time that they deliver the new options, then my customers most likely is going to start buying more cars. More cars for me means more profit. Once I speed up on the time, that indirectly is going to reduce the cost, which is going to increase the contribution per car, which also is linked to my profit. Time decreases, satisfaction increase, contribution increase per car. And that's how we should look at it. If the normal car sold and the contribution per car increase, obviously the result will be hit me on the profit. But again, if you want to see something on the top, you have to start digging from the bottom and implementing. And don't worry, the profit's gonna come. One day you're gonna hit the right button, everything's gonna work. The only thing is don't stop learning and growth. Because we're living in the constantly changing environment. Once you relax and say, okay, that's enough, that's where you're gonna lose. There's not enough. I'm sorry. Some people thinking that I'm in the school and when I'm learning in the school, that's once I finish the school, it's over. I don't have to learn. That's totally wrong. If I don't learn every day, I won't be able to meet your expectations. I won't be able to meet your needs. I won't be able to create value for you. And if you don't see value from me to yourself, there's no reason to you to take my classes. Make sense? So that's how you should approach every time when you're going to the situation. Try to create value for the other people. And don't worry, the value is going to come back to you. Don't forget, what you give is what you get. If you give more, you're going to get more. If you give less, you're going to get less. If you give nothing, most likely you're going to get nothing. So never stop, learn, and grow, people. I believe that should be the philosophy of life for us as a human being. Constantly to learn and grow and experience and get more experience and get more experience. Adjust to the situation, keep going. As you can see, we're not living in a static situation. Situation constantly changes. So that's with this. Now, one thing that I want you to know, we're going to talk about this advanced managerial accounting of those people who's going to take the course with me on the transfer pricing. Transfer pricing is part of the decision making, but I think I'm going to leave the transfer pricing for the next time because we have a lot of time left. So if it's not next time, we're going to cover it on the next lecture. We have two more lectures, three more lectures. So I have enough time to cover chapter 12 and the transfer pricing, and we'll be fine with this. I think that will be a good end of the day for today's lecture. You to create value for yourself, which is going to improve the value in your customers. And then you're going to get what you want. The final class. Will the final class be reviewed for the final? Yes. So now the way I'm seeing is